Okay, class number 8. So business combinations. So in this class, what we're going to talk about are the tax accounting issues that are relevant when one company buys another company. Okay? And in our area, there are acquisitions happening all the time. So while these issues, if you work at a company, sometimes come up only every once in a while, I mean, if you work at a firm, you see acquisitions all the time. I mean, all the time. So business combinations, while the issues sort of seem unique as you're learning them, or they seem like they would be the types of things you would apply infrequently, this is a core skill set if you're going to work on provisions. You got to know business combination issues. Okay? But starting with the big picture, think of, okay, one company's going to buy another. What provision issues does that create? Okay, that's really the agenda for tonight's call, or tonight's class. Okay, so the way that we're going to think about this is we're going to go in a sequence. And so starting in the upper left-hand corner of this slide, so the first thing we're going to do is just try to understand the transaction. Okay? It's funny how often I'm working with a client right now that doesn't even understand their own acquisition of a target. And it's just very hard to get the accounting right before you understand what you did. And, you know, if you've ever worked on an acquisition, you'll find that there's always an agreement, and that agreement's always 100 pages long, and it can be complicated. And so take the time to understand, like, what did I buy? What was the structure? What are the tax implications? Like, forget provision. Just think tax. Like, what happened? What are the tax effects? And make sure that you don't just kind of jump to a quick conclusion. Make sure you understand. Is it taxable to the seller? Is it not taxable to the seller? If it's like a reorg, or for the buyer, did you get a basis step up, or did you not, or did you carry over attributes? Like, ask lots of questions of what happened in the acquisition, because it's only once you understand all the facts that you can figure out how to do the tax accounting. The second step is what I refer to in this blue thingy as PPA adjustments. So PPA is purchase price accounting, or purchase price allocation. And so what, you know, just in industry, what you hear PPA referred to as is the exercise that the accounting team goes through to take the purchase price and allocate it to the assets acquired. Okay, so regardless of what the structure of an acquisition is, for book purposes, the purchase price gets allocated to what assets came across on a fair value basis. Okay? So like Avago was your 10K reading for tonight. I picked Avago because they've done some big deals recently. And so in the 10K, you see that they include a disclosure for each of the deals, and they say we bought LSI and we paid $6 billion. And then right below that, they show you how they allocated that $6 billion to the assets. So they say $1 billion was intangibles, and $300 million was accounts receivables, and some was inventory. But they take that $6 billion and they push it out to the assets that came across, and some valuation firm helped them do that. Okay? And then almost without exception, the biggest piece of what they allocate their purchase price to will be Goodwill. But the core fact is that the accounting team will take purchase price, they'll allocate it to the assets, they'll basically take the acquired company's balance sheet and put it on a fair market value basis. Okay, pushing down the purchase price to the asset. So you need to understand how that works, because if you learned anything about deferred accounting so far in class, you're going to think anytime I have an asset or liability where the book basis differs from the tax basis, I'm going to have a deferred tax asset or liability. So when the book guys do their PPA, what they're doing is changing the book assumption for the carrying value of assets and liabilities. They're like hitting a reset button. They're starting over. So when they start over, that means we in tax have to start over in measuring all our deferreds. So we'll talk about this later in terms of how this works. But just know that tax is going to jump onto an accounting process to push the purchase price down to the assets. And then we're going to take hold of what they do and figure out what it means to us. Okay, that's second box. Third, so we need to think about, well, what else did we get? Right? So take Avago. Avago bought LSI. Well, what did Avago inherit when they got LSI? So one of the things was NOLs. right? LSI had losses, and so when Avago bought LSI, Avago has losses now. So we got to figure out, are those good losses? Can we use them? Are they limited? Do they disappear in the transaction? Like, what happens? So we need to figure out, in addition to the whole purchase price allocation, like, what other tax-only things do we care about? So NOLs is an easy example. And then let's say that LSI had exposures, reserves. They had non-current liabilities that they had accrued under FIN 48. Well, those exposures are going to come over with the target, and they're going to become Avago's exposures. Okay? Not in like a legal sort of way, but from a consolidated financial accounting way. Whatever was on LSI's books are going to move over effectively to Avago's financial statements. Okay? So we need to think about not only what's books doing, but what are the tax-specific items that are relevant to us. So moving down to the lower right-hand corner, anytime there's an acquisition, there's banker fees, there's lawyers, there's like me, accounting firms. You know, there's lots of costs. And so the book rules for how those costs are dealt with differ from the tax rules. And so there's going to be a book tax difference, and we need to know how to deal with it. And while that might not seem like that big a deal, sometimes those costs can be big. The bottom middle discusses what happens after you close a deal and then you realize later you got it wrong. So sometimes when an acquiring company buys a target, it takes a while for the acquiring company to figure out everything that's going on with the target. Right? Like, you know, maybe LSI is a complicated company with a long history, which is the facts. I mean, LSI was one of my clients, and so was Avago. So LSI had been around for a long time. They had done acquisitions of their own. They had a history. And so if you're Avago and you think, well, I need to learn everything about them so I can do my purchase accounting right, well, that might not be something that you can just quickly do, right? It might take a long time. And so maybe 6 months after the acquisition, you're still figuring out, like, are those NOLs good? Do I have exposures in certain jurisdictions? And those things are still getting, vetted. So the accounting, the business combination rules allow you a period of time to true up your original estimate in terms of what you did for your acquisition accounting. And so we'll talk about that period that you get to book post-closing adjustments in. And then the last thing we'll talk about is disclosures. But think about this topic in a sequence as opposed to just a series of issues, because everything happens chronologically in a business combination, and it sort of happens that way every time. Okay, slide 4. So taxable and non-taxable acquisitions. So this can be a term or terms that are confusing, because the way that this term is defined for our purposes, for tax provision purposes, is not necessarily the way you might think of it as like selling shareholder. A taxable transaction means there is an inside basis step up in the assets. Okay? So that means that the transaction is structured in a way so that the acquiring company, when it obtains the assets of a target, the tax basis in those assets gets stepped up to fair value. And that usually means that the buyer has acquired assets in a taxable transaction. So it could buy assets directly, or it could buy stock and make a 338 election like is described in the second bullet. So the purpose of this class is not to teach you how acquisitions work, but know for now that when we say taxable transaction for provision purposes, we mean a transaction that's structured for tax purposes to provide a basis step up for tax purposes. A non-taxable transaction is really anything other than that. So if a buyer acquires stock in a target, okay, so I'm a buyer, I go pay $100 for the shares of a target, then in that situation, there's no basis step up in the assets of the target. And the reason is we just bought stock of the target. We didn't buy the assets. And so the way this works for tax purposes is if we buy stock, our basis in the stock is fair value, but it doesn't get pushed down to the assets unless we make a 338 election, which is uncommon. So if we acquire the stock of a target, or if we acquire a target in what's referred to in the second bullet as a tax-free reorganization, in any of those transactions, for tax purposes, we're not going to get a basis step up in the underlying assets. And so that will be defined as a non-taxable transaction. The reason that's confusing is if I acquire stock in a target for cash, while I, the buyer, might think of that as non-taxable because I didn't get a basis step up, the selling shareholder is taxed on that sale. So it feels very taxable to that person or persons. But again, for our provision purposes, the definition of taxable or non-taxable depends upon whether there's a basis step up for the buyer. Okay, we clear on that? Okay. Tell me, and be honest, if I should spend like 5 minutes explaining like why companies buy assets or stock, so we have like the basic framework of that. Yeah? Okay.
Yeah, do you want to ask a couple of questions? Then maybe you can confirm that you will cover it in the example, if not incorporate it in that.
Okay.
Is that okay? So first to the people.
You're assuming I could stop you otherwise.
First, going back to the PPA, if the buyer chooses to make a 338 election, and it's a stock purchase, so say the subsidiary was worth like $1 billion net assets, so you paid 60, so you paid 5 more than its book value.
Okay.
So when you step it up, effectively the whole company, on an asset and liability perspective, is now 16. So how does the accounting work at the subsidiary level? Do you literally go and revalue each?
We'll explain later. I'm going to show you an example.
Okay.
Do you have another question?
And the next question was to do with the 338 election itself. So in situations where tax purposes you make a 338 election, could you go through the mechanics in terms of exactly how things appear on the buyer side?
I'll try. Okay. So let me just take a few minutes and explain asset versus stock. Okay. So again, this is not provision stuff. This is just sort of M&A 101 from a tax perspective. Okay. All right, so let's say that I form a company. Let's say this is me. I'm a person. And I form a company, a corporation, X. And I just come up with a really good idea. Okay? So in this company, I have assets. But that asset is really just a good idea, right? So that's very Silicon Valley-ish, right? There's not like a big plant or a building or whatever. It's just some desks and chairs and a good idea, okay? And let's say that there is Big Co. that finds out I have a good idea, and they're like, we want to buy your big idea. We're Big Co. Right? And so what they're going to do is they're going to say, hey, we want to buy your business. And I say, fine. I'll sell it to you for $100 million because this is a good idea. Okay? And so the buyer is going to say, fine, I want to buy assets. Why do they want to buy assets? Because they get basis, and then they get to amortize that $100 million over some life, probably 15 years. but they get to deduct the $100 million purchase price over a period of time. So they want to buy assets. Me, I want to sell stock. Okay? Why do I want to do that? I should be ecstatic to sell assets. They want to pay me $100 million, right? Okay, why do I want to sell stock? So the one answer was capital gains, but not really. Anybody? Yeah, double tax, right? So if I sell the stock for $100 million, I'm going to have $100 million of proceeds. I'm going to pay tax of, say, $20 million. Let's just deal with federal. I'm going to have $80 million left over. That's some good walking around money, right? So if instead I don't know any better and I say, oh, sure, I'll sell it. If you want to buy assets, that's cool. I'll sell you assets. So if I sold assets, the way that would work is this company X is going to sell the assets. They're the one with the assets, not me. And $100 million goes this way. So X is going to have $100 million of proceeds, and it's going to pay 35 of tax. So there's going to be 65 left over. Okay? Because there's no corporate capital gains rate that's low. It's just a standard 35% rate. But now I have a company X with $65 million in it, which sounds great, but I need the money, not company X. So if that $65 million was distributed to me, or if X liquidated, then I would have 65 of proceeds, but I now have a gain. I gave up my shares that are apparently worth $65 million. I liquidated the company, and my basis in the company was zero, right? All I did was come up with an idea. So I'm going to have to pay tax on the $65 million, so at 20%, that's $13 million. So I have $52 million left over. Okay? So if I have any sort of advisor, they're going to say, hey, if you sell assets, your walking around money is going to be $52 million, versus if you sell stock, it's going to be $80 million. And so I'm going to be like, I definitely need the extra $28 million to make ends meet, right? So that's a big difference. So buyer's going to say, hey, but what about me? I mean, if I buy assets, then I get to deduct the $100 million. But if I buy stock, I don't. So from a buyer's perspective, there's a benefit of 35% of the 100. Oops. So there's a 35 benefit. So in theory, you could make this work, right? I save 35, I'm the buyer, but it only costs you another 28. Like, there should be a way we can make this work. But why doesn't it work? The answer is this happens over 15 years, right? This happens now. And so once you apply any sort of discount factor to this, the benefit to the buyer is going to be less than the cost to the seller to transform a stock transaction into an asset transaction. And so the fact that there is double tax at the seller level, both here at the corporate level and then again at the shareholder level, that double tax makes acquiring assets inefficient. Because again, the basis step up to a buyer is not worth it. And so lots of acquisitions, especially when you're dealing with people that haven't been down this path before and don't know the drill, you'll have this tension of seller wants to sell stock, buyer wants to buy assets, neither side understands why the other can't come around to their point of view. But once you do the math, it always ends up like this. And so a transaction like this will end up being structured as a stock purchase. And the reason is that these guys are never going to be willing to pay enough to the seller to get them to agree to sell assets. It's never going to mathematically work unless there's some really strange facts. Because if you're the seller and you say, hey, buyer, look, I want $80 million, right? That's, at the end of the day, I want you to get me that. So if you want to adjust your purchase price and structure this as an asset deal, that's fine. I just need to have $80 million to walk around with when I'm done. So we can just back into what that purchase price needs to be, but mathematically it's going to get to a place where it's not economical for the buyer. Okay. Does that make sense? Seriously make sense? Or you're like, just keep going? Where did I get the 20 from? This would, the 20 here? The 100 minus 20 is, this is proceeds, this is tax, and so that's cash. And so remember that even these are just federal taxes, so you can imagine how depressing that 52 million number comes when you throw in state taxes, right? Because California has high corporate taxes and high individual taxes, so that number would get like laughably small once you throw in California taxes. Okay. Yeah? Good? All right. So I will try to cover how 338 works. Okay. I'm going to cover it sort of quickly, and if I lose you, too bad. All right. So let's go back to my fact pattern. Me, X, Big Co. So let's say we have the conversation I just described, and I, as the seller, I hold firm. I say, I'm only selling you stock. You're not willing to adjust your purchase price high enough, so you pay me $100 for the stock. I'll give you the stock. I pay my federal tax. I'm sitting on the beach. We're all good, right? So let's say that's what happens. So these guys give me 100, and I give them my X shares. Okay? And so now, X is a subsidiary of Big Co. Okay? But X didn't get to step up the basis in its assets. So, if I wanted to, I could make a Section 338 election, 338G, and what that election would basically do is it would allow X to sell its assets to itself in a taxable transaction. Okay? And the way 338 works is it basically says, it creates the fiction that there's an old X and a new X. And the old X sells the assets of old X to new X in a taxable transaction. So what you've done at the X level is you've said there's a fictional asset sale to, quote, new X. Okay, but what you're doing now is you're saying, okay, well, what happens at X? Well, X would be treated as selling its assets for 100, and it would have to pay 35 of tax. Okay? So if we made a 338 election, X would have to cut a check to the IRS for 35. In return, okay, so that's tax going out the door. In return, new X gets basis of 100, and therefore in the future will save 35 of tax. And that will be cash coming in the door through tax savings. But it's the same dynamic of I have to pay this 35 now. I save this 35 over 15 years. So in a very generic vanilla fact pattern, that's an idiotic thing to do. You wouldn't say, I would love to pay you 35 of tax now so I can save 35 over 15 years. Right? That's like the opposite of how our debt finance government works, right? We do the, we do the opposite of that. So in in normal situation, you wouldn't make a 338G election because it's just simply not to your advantage, given the timing difference between when you pay the tax and when you save the tax for the basis step-up. So in a straightforward domestic acquisition, you almost never see a 338G election. It would have to be a very rare fact pattern. Okay? Did that answer your question, you said?
In a domestic situation,
Yeah.
you don't go forward.
No, we'll cover that in class. If you want to cover that. We'll be here forever if we don't get off slide 4.
So basically, can I just cover it really quickly?
No.
10 seconds.
No, we'll cover it later. All right. Trust me, we've confused the group enough. Okay. So we need to think about, and I put this little visual here because, to me, I mean, there's 4 kinds of acquisitions. And here's where I'm going to confuse you, because I use the terms taxable and non-taxable in this diagram differently than the way I described it like 5 minutes ago. So if I'm a buyer, I can either buy assets or stock. And I can buy assets or stock in either a taxable way or a non-taxable way. And on this diagram, what I mean is it taxable to the seller? So I can structure a transaction so that I acquire the business of a target either in the form legally of acquiring their assets or in the form legally of buying their shares. I can do that in a way that is taxable to the seller or is not taxable to the seller. Virtually all acquisitions, I mean, I would say 80% plus, maybe 90% plus, fall into this category. And the reason is in order to end up in the category where it's non-taxable, you have to use a significant amount, and sometimes, depending on the structure of the acquisition, the entire purchase price has to be buyer equity. Okay? So that means the buying company has to give the target as the purchase price, not cash, but buyer stock. And the theory is that if, from a tax perspective, the theory is if buyer simply gives the selling shareholder equity in this acquiring company, the selling shareholder really hasn't cashed out. They're still a shareholder in that historic business through the equity of the buyer. So if you haven't cashed out, it doesn't seem like you ought to be paying a lot of tax. So in a transaction where the buyer says, hey, acquire a target, we're going to give you guys shares in our acquiring company. You give us the stock of your target. Now we've just really combined 2 businesses together. Nobody's walking away with a pile of cash. We've really just combined the equity of 2 businesses, put them together, and we're running the businesses together. It sort of feels like the type of event that shouldn't be taxable. And that's the idea behind a tax-free reorganization. What you've done is you've deferred the taxation because the basis in the shares you get from the buyer will be a carryover basis from the shares you had previously in your target. Okay, so tax-free reorgs defer tax. But in most cases, buyers, or sellers rather, they want to go sit on a beach, right? And so they don't want buyer equity. They want cash. And once you start paying with cash, taxable. Okay? Once you're taxable, whether it's asset versus stock is a function of what I described a minute ago. Right? Whether I buy assets or stock is a question of what's the most efficient thing from a tax perspective. And while I explain that a stock purchase is going to be more efficient, that won't always be the case. The reason I put a yellow box in the stock taxable column is because most transactions look like what I described here. But if I changed one simple fact, if I made X an LLC, and this was a partnership instead of a corporation, now there's not 2 levels of tax to acquire assets. There's only 1. So now it could be very efficient for buyer to buy assets, because seller is going to say, oh, I don't have to pay tax twice, I only have to pay once. Like, now we're talking. Now I might sell you assets. Okay? But oftentimes, because private equity funds so many of the venture-backed companies and they don't want flow-through structures because it screws up their private equity investors, which is a topic that is far, far beyond the scope of this class, most venture-backed companies are structured as corporations, which creates a double tax tension. And so you see acquisition structured like the yellow box because we're in a corporate form, we have double tax, it's not efficient to buy assets in double tax, and people want cash. So if you want cash and it's not efficient to buy assets, upper right-hand corner. Okay? All right. So for, I think, the rest of this class, we're going to assume that when we talk about an acquisition, we're talking about an acquisition that is a stock acquisition, meaning legally we're buying shares of a target, and we're buying the target shares with cash. Okay? And again, those 4 boxes are not created equal. Almost everything that I work on tends to be in that upper right-hand corner, with just a few exceptions here and there. All right. So now, that first series of slides was meant to correlate back to that first box in that sequence slide where I talked about the first thing you got to do is understand what happened. You got to understand the structure, right? Did I buy assets? Did I buy stock? Did I get a basis step up? Like, what is the transaction? And a lot of times, just speaking extremely practically, you'll pick up a document and it will include mergers. Not all mergers are created equal. And so you can have a merger that effectively facilitates a stock acquisition. You can have a merger in any one of these boxes. So when you see an agreement that says merger, don't assume that that is one of these boxes. You have to then read further and figure it out. And oftentimes agreements have more complicated transaction steps that have multiple mergers. In fact, it's very common. So you have to read very slowly, sometimes draw it out, and understand what the transaction form is. Because to me, like if you say merger, oh, I think asset transaction. Like that's what a merger is. The entity goes away, assets transfer. But no legal form and tax treatment, not always intuitive. Okay, Ben, from here on out, buyers buying the target for cash. Okay, so in our first example, we buy the target shares for $1,500. And remember how in the second box in the sequence I said the accounting team is going to do a purchase price allocation. So the accounting team says, hey, great, we just bought a target. We paid $1,500. We got to figure out what that $1,500 belongs with. Okay, where does it go? So regardless of what was on the target's balance sheet before we bought them, we're going to throw that balance sheet in the trash, and we're going to start over. Okay? So in this example, the acquiring company says, you paid $1,500, and we're going to allocate that to 3 different assets that you acquired. Depreciable property, intangibles like technology or patents or whatever, and then goodwill. And then you'll notice that the tax basis in the second column are completely different numbers. And those numbers are going to be simply whatever the tax basis was in the assets that the target was recording before the acquisition. Because if we're buying shares, nothing happens to the basis of those assets. Okay? So that basis is just the historical basis. But books hit a reset button. And so now book and tax are completely different because for books they got to change the rules, right? They got to start over. Okay, so these are our base facts. These facts that I'm showing you, like this is totally typical. Okay? This happens all the time. So, if we were to acquire the target in an asset purchase, well, we wouldn't. But if we did, our tax basis in the assets should be the same as books, because when you buy a company in an asset purchase, the way that we would allocate our purchase price to the assets will usually closely mirror the way that books does it. And so the purpose of this slide is to show book basis, that's based on a fair value allocation. If we bought assets, taxable asset, our tax basis would reset too, so there would be no difference. But again, I told you we're not going to assume that those types of transactions happen. So if we moved on to a non-taxable stock purchase, this is the more common one.
On the previous slide, would the tax basis be equal to? Would we use the accounting treatment for fair value, or would we do a separate valuation?
So Yusef's question was, will it always be the same? It won't always be the same, but the concepts are the same. It's a fair value allocation. You go from current liquid assets down to non-current intangible assets. Goodwill's a residual. So while there's different rules, in a straightforward taxable asset transaction, they should be similar or the same. Okay, so here's the transaction I want you to really focus on. Non-taxable stock purchase. So we buy the shares of the target for $1,500. There's no 338 elections. There's no tax basis step up in the assets. Books does its reset button thing. They take the purchase price, they allocate it to the assets. Okay? How do they allocate $300 to Goodwill? How does that work? Anyone know? How do you determine the value of Goodwill? You can get a valuation firm to tell you what's the property worth, what's the intangibles, patents, whatever worth. How do they tell you what the Goodwill's worth? It's a plug, right? Okay, good. Okay, so in a stock purchase, our tax basis is historical, right? This didn't change from what it was. So now we have a whole bunch of differences. So those differences are our temp items. So far in class, you've learned about temp items as I add back something in year one, I deduct it in year two, it sort of comes full circle, right? This is a temp item too, but it doesn't work quite the same way. So if I bought this company, and for book purposes, I put a $200 value on the depreciable property, but my tax basis was only $150, if the next day I sell that depreciable property for fair value, I sell it for $200, there is no book gain. I sold it for what books recorded it as. But there is a tax gain. So I don't have both sides of a temp item. I just have the reversal of the temp difference that sort of appears in the business combination account. Because the book guys were able to reset the value on their carrying value for the assets, that creates temporary differences without me having to have the one side of a temp item. Okay? So you need to think of this as, what would happen if I sold my balance sheet for cash? What happens if I sold depreciable property for $200? What if I sold my intangibles for $1,000? What would be the tax effect? And that tax effect I need to accrue as part of business combination accounting. So just like books would say, hey, you bought a patent, that's great, we should book an asset on the balance sheet. Us tax guys are going to say, hey, don't forget about us, we always come last, but we're pretty important. Don't forget about the fact that you're going to inherit, in this situation, a ton of deferred tax liabilities. Because if you sold all these assets for cash, there's going to be a big tax gain, but no book gain. So we need to anticipate that and book our deferred tax liabilities as part of the acquisition. Okay. So looked at another way, you're probably thinking, well, what if I don't sell my assets for cash? Okay, fine. If you don't, you're going to depreciate the $200. You're going to amortize the $1,000 for book purposes. All that's going to go through the income statement over a period of time. But the only tax deductions you're going to get are going to be the $150 of tax basis and depreciable assets. So you're going to have a big book tax difference over time because the book expense for recovering these assets is going to be very different than the tax deduction. So again, unless you set up a DTL for that as part of purchase accounting, you're going to be lost. Like, what do you do with that book tax difference? That book tax difference is the reversal of a temporary difference that appears in business combination accounting. Okay? So what we will do is we will come and compute that 420 and say, hey, accounting guys, based upon the way you've allocated the purchase price to assets, there's 420 of deferred liabilities that you need to book because you stepped up the value of the book basis in assets. And so that journal entry is going to be a credit to DTL, because we got to book a credit to DTL, and then it's going to be a debit to Goodwill, but only for this piece, at least with respect to the tax entry. So what us tax folks are going to say is, hey, accounting guys, when you bought this target, you inherited a deferred tax liability when you stepped up the basis and the assets for book purposes, and that deferred liability is like any other liability. If you assume it in a transaction, that must mean there's more goodwill. Does that make sense? So let's say that I'm buying a company that Kate owns for $1,000, and there's two assets. There's the desk she's sitting at and Goodwill. Okay, so I pay $1,000, and Kate's like, "You're a moron. The desk costs $100, so therefore there's $900 of Goodwill." Okay? If I also agreed to inherit her car loan. Okay, so let's say that her car loan was another $500. So now I'm paying her $1,000 plus I'm inheriting a $500 liability. So it's really like I'm paying $1,500 for the desk. And then she's going to say, you're truly an idiot because the desk is still worth $100. So now you overpaid not by $900 but by $1,400. That's the same as this. When we inherit a deferred tax liability, it's like saying, well, whatever the assets are we got, they must be worth more because we paid more purchase price by assuming liabilities. Okay? I know deferred tax liabilities feel fictional and it's sort of not real, but if anyone they should feel real to, it's you. I mean, you're the ones that are actually care about this stuff. Okay. Okay, so you picked up on a good point. All right, at least one person is paying attention. Not a bang. Okay, so her question was, why don't you book a deferred liability here? Okay? So that's a great question. So why don't you? Hold on, what was that? You cannot set it up. I know why. Well, you definitely have a gain. Book value is higher than tax basis. Why can't you set up a deferred liability on Goodwill? Of course the rule is you can. And so, but I want you to understand why. It'll help things click. Okay, so let's play it out this way. What if you did? How would it work? You'd set up a deferred liability. The other side would be Goodwill. But now you need more deferred liability because your book basis just went up again, but your tax basis is unchanged. So it's circular, right? So Goodwill is already the plug. So it doesn't make sense to put a circular gross-up calculation on a plug, right? That's sort of just like insanity. So the accounting rules say Goodwill is the residual. There's no point in grossing up Goodwill. And so you don't book deferred taxes on Goodwill, and therefore you don't have the gross-up feature. Now, we're not going to really get to this topic in class tonight, but if you had tax basis in Goodwill that exceeded book basis, which can happen, you do book a DTA for it. So the rule works the opposite when the facts are the opposite. But again, that's a sort of a rare fact pattern, although it can happen, and we're not covering it in class, and it's not on the exam.
For book purposes, when the accountant book the fair value, what's the opposite entry? Where does it go?
When the book guys book the entry for fair value, they book it like that. They book it to equity.
Oh, it's right there for equity?
Yeah.
But it's not shareholder equity, right?
So this is the subsidiaries books. If the buyer acquired the target for cash, the credit side of the entry is cash. If I pay $1,500 and I'm the buyer, I'm going to credit cash $1,500 and I'm going to put all these assets on the book. If I'm looking at my subsidiaries books, the subsidiary will have equity, the buyer will have an investment, $1,500. But don't worry about the subsidiary accounting stuff. Just think credit cash, buying a bunch of assets.
So this accounting is in the acquired subsidiary.
This, yeah, this accounting is looked at from the subsidiary's perspective only, not from the consolidated financial statement.
So the term pushing the goodwill down is this one?
Here we have pushed it down. Yes, we'll get to that later.
Oh,
And you're full of questions. Yeah, yeah, we'll cover that later. That's more important in a foreign context than it is domestic. Okay, we good on this? This fact pattern, this is important. You need to know this. Anyone thinking, I don't know this, but I don't want to say so? Okay. Let's go a couple more slides and we'll take a short break. All right. Parent acquires target stock for $150,000. Non-taxable transaction. That means we bought stock for cash, and I'm calling it non-taxable because I'm not getting a basis step up in the assets. The depreciable property is worth 20. The intangibles are worth 100. Assume a 40% tax rate. We do our PPA, carry over our tax historical basis, and the target has an NOL. So up to that point, the first two paragraphs sound like the example we just did. Bought stock, no basis step up, books does a PPA, tax has historical cost, we compute our deferred taxes, we book our entry through Goodwill, it's all good. The only thing we're adding here is the last part. Assume target has an NOL of $120,000, a tax basis that's low and the PPE and no valuation allowance. What's the gap entry associated with the transaction? Okay. So just like in the example we went through earlier, books is going to do its thing. It's going to allocate the 150 purchase price to the assets. Okay? Tax comes along and says historical value. But part of that historical value includes the NOL. Right? Because the NOL is going to create a deferred tax asset that we get in the buyer, or the target. So the deferred taxes that we set up are the same as our first example, like DTLs for the fixed assets and the intangibles, but now we have a DTA. Okay? So you're like, hey, this is great. Not only did we buy a business where we inherited some deferred tax liabilities, but we actually got this big asset. And so it can work the opposite way, where my net entry is actually to book a net DTA. Okay? And so in a situation like this, my deferred tax asset net will be a debit here, and my goodwill, this includes the 4K offset. Because I would tell the accounting guys, hey, you might have thought that when you paid $150,000, you had 30 of goodwill, right? Because that's what they thought before you told them about deferred taxes. But then you're going to say, hey, you actually don't have as much goodwill as you thought because I found you an asset, right? So that must mean you didn't have a premium of $30,000. You had a premium of something less than that once you factor in the tax assets. But now, hopefully, you can appreciate that it's pretty important to make sure that when you book an NOL like that, that this is a good asset. because you wouldn't want to book that entry and then later think, oh, I guess it's all limited by 382, I can't use it. Right? Like that would be a problem. Okay? But the point of this extra example is, okay, fine, take our base facts from earlier and now add an NOL. What does that do to the mix, right? All it does to the mix is it adds a potential deferred tax asset that we would have to account for as one more acquired thing. Okay. You guys do exercise 1, and then after that, we'll go through that together, and then I'll explain the push-down concept that I just skipped over on the slides. Okay? So let me give you like 10 minutes. I think this one will be relatively quick, and then we can regroup. Okay, so we're going to go over in-class exercise 1. All right, so in class exercise 1, there's 2 steps. The first is, what is the journal entry you book at the acquisition? And the second is, what's your year 2 provision? Okay? Okay. So we're going to say that we've got our book basis and we've got our tax basis. And in the target, we had PP&E, which book said was 2, tax said was 0. We had IP, which book said was 35, tax said was 0. There's Goodwill, which is the residual, which is going to be 63, tax is 0. And then there's an NOL that's 60. Books is going to be NA on that. And there's a tax exposure of $4 million that we're inheriting as well. Okay, so if we were trying to come up with our deferreds, we would say I have a taxable temp of 2 in the PPE, a taxable temp of 35 in the IP. Goodwill is going to be NA, because book is more than tax, and I don't want it to be circular. And I have an NOL of 60, which is going to create a deductible temp. So the net of those is 23 times 40% is going to be 9.2. Okay? So I would book a 9.2 deferred tax asset. I'm inheriting exposure of $4 million, so I've got to book a credit to my balance sheet of 4 for my FIN 48 liability. So my net tax entry to Goodwill is 5.2 asset. So that means my total Goodwill is going to be the sum of this 5.2 and the sum of that 63. So it'll be 68.2 when I'm done. I don't know. Anybody get with that? Oh, you're right. Sorry. The 5.2 will cause the 63 to go down. So the 63 minus 5.2 is going to be 57.8. Okay? Follow? Okay. That's the easy part. So now, year 2 provision. Okay? I set up my deferreds, and now I got to do a year 2 provision for this company. And the assumption is, even though buyer bought target, really we're just dealing with target's differences between book and tax. And we're just assuming buyer's simple. Okay. But those are our opening deferreds. Okay, so now I get to year 2, post-purchase accounting, and I've got $30 million of profit. So I'm going to do my step 1, my current provision. I'm going to start with $30 million of profit. Including in that is $1 million of depreciation for books, but I don't have any tax basis, so that means I got to add back 1 for depreciation, and that includes 7 of amortization of IP, but I don't have any tax basis in that, so I got to add that back too. So my taxable income is 38. I'm going to use 10 of NOLs, so I have 28 of taxable income, a 40% rate, 11.2. So my current provision will be 11.2. Right? That's current. Now deferred. So I'm going to do this sort of thing. I'm going to do like a beginning of the year, a change, and an end of the year. So I had PPE, IP, and NOL. And that started as 2, 35, 60. And it went down by 1, 7, and 10. So now this is 1, 28, and 50. Yeah. So my deferred provision is this, which is debit provision, credit DTA for 40% of that. Right? Because these numbers are all pre-tax, so then this is going to be 0.8, 0.8. So my total provision is the sum of this 11.2 and this 0.8. So the sum is 12. So if I was doing a rate rec on this, it would be really easy. Right? Like easiest rate rec ever. 30 of PBT times a 40% tax rate is 12. There's no perm differences. This is just simple temps. But again, it's confusing because the temp, you're only seeing it go one direction. Right? Because I set up all my temps in purchase accounting through Goodwill, and I'm reversing them through the provision entry. Okay? So the moral of the story is, if I didn't set up all these tax entries, right, if I didn't set this up, then when I get to year 2, then how do I explain all my book tax differences, right? If I didn't have all those deferred set up, somehow this 2 would end up rolling through provision, but yet that 2 is the reversal of a number of book tax basis differences that I can measure right at the date of purchase account. Okay. You following that? Yeah. Oftentimes what you will see in a deferred roll forward is you will see somebody say like, okay, my deferreds at the beginning of the year were X. I had current year activity, current year change for Y, and then I have an end of the year, right, which is the sum of everything over that way. But if I want to create deferreds through acquisition accounting like here, like suddenly 9 of deferred showed up, the way I oftentimes will do it in my deferred roll forward is I'll put an acquisition column here, and I'll say this is my M&A balances. So if I had a PP&E deferred, it just pops in, or if I have a NOL that popped in, then great. Because the sum of this column, I'll know it's going to be, debit DTA 9.2 in my example, credit Goodwill. And that's a different entry for that column in my deferred roll forward than my current year activity. Because this entry is going to be one side to deferred tax asset or liability, and then the other side to deferred expense. So what I always encourage people to do is in their deferred roll forwards, have separate columns for the activity in the deferreds, which goes different places. So if you put everything into one column, it's really hard to figure out, well, how did the deferreds change? Because normally, you would say the difference between my beginning and my end is deferred expense. But in this case, the activity that relates to this, that doesn't go through deferred expense. That goes through the balance sheet. Okay? So think in your deferred roll forward as of creating another column to say, if I'm trying to explain how my deferreds get from the beginning of the year to the end of the year, I don't necessarily want to do it all in one way because the entries I book to move them from beginning to the end of the year, they differ depending on the nature of the movement. Okay. So I skipped over this slide earlier, push-down accounting. So let me just explain this by way of the example. So buyer acquires Target for $100 million. Target is in Europe, and it has locations throughout the EU. T has IP, and the rest of its assets aren't worth much. The IP is recorded on the acquisition company's books and is not allocated to each location. Acquisition company records a 25 million DTL using a blended rate derived from where T operates. Okay. So if you have a company that's in multiple jurisdictions, it's important to figure out when books allocates value to the assets, what jurisdiction that value is in. Because not all jurisdictions are created equal. Okay? So, in my example, if I looked at where the IP really is, if I said, for example, that the IP is all in this jurisdiction, instead of spread amongst the different jurisdictions, my tax rate here is only 10%. So, like, let's say that this entity right here, this was my entrepreneur. But these guys, let's say these were all just like G&A companies, service providers. Well, you can't just naturally take a blended rate for the target companies or look at the target parent's rate of 25%. You got to figure out where is the IP. So when you do a global acquisition, T in the T group, you've got to do the analysis in this slide where you do book equals tax. You got to do it in every box. So that purchase price needs to be pushed to the relevant box so that in this box you can do a book equals books versus tax basis calculation. And then you go down here and you do book versus tax. And you go here, book versus tax. You got to do it at all the relevant subsidiary entities. Because just booking the premium top side and assuming you can use a blended rate, that won't work. And if you're thinking, well, why would you ever even book it top side? The answer is, a lot of times that's what happens. And the reason is it's just simpler to book a topside entry to reflect the premium that the accounting, when the book guys come in and say, oh, well, your historical balance sheet showed 100, but we paid 1,000, I'll just stick 900 on the top. And when we consolidate in, everything will work perfectly, and I didn't have to push anything down and mess up the local books. Okay? And if you do that, while that's simple for book people or the accounting types, it's not good for tax because you don't get it in the right place. So true story, one of my clients actually, they bought a Target. This is quite a long time ago, but this is a company you would all recognize. They were the buyer, and they bought a target, which was a U.S. company, but it owned a Cayman structure. And about, call it 60% of the business was owned by the Cayman entity through a cost-sharing structure. Okay? So 40% of the value of the business was in the U.S., 60% was offshore. We paid a huge premium. So what they did was, in consolidation, they booked an entry here, which was debit, IP, and goodwill, credit, equity for $100 million, and they did it on the U.S. books. They didn't bother pushing some of it down to Cayman because they're like, well, Cayman's not even like real. It's just this, shell company. So the tax guys came along and said, let's assume it's all IP. They said, oh, looks like there's IP of 100 for books. There's no tax basis, so we need to set up a DTL of 35. So they booked an entry, which was debit goodwill 35, credit DTL 35. And then we came along and said, oh, that's not good, because 60% of our IP is actually in the Caymans. But you just assumed that 100% of this IP was in the U.S. by setting up that. And for this company, they set up too much DTL. Right? It was way too high. This should have been like 14, not 35. And for that company, that difference was big. It was like, the real facts were something like 60-something million of like, oops, like we said. Yeah. And so we had to tap dance around that one. And it was all because the accounting guys took a shortcut and they booked the entire purchase price allocation on the top side. And they said, let's just leave the subsidiaries books alone. Let's just book one little top side entry to reflect the step up for book purposes. And we'll just book it in one place. And then the tax guys were like, well, if they booked it in the U.S., it must be a U.S. thing. But that was just because they were lazy. It wasn't because that's right. So you got to be careful about that if you're dealing with a multi-jurisdiction acquisition. All right.
Did you put DTAs in, if it was determined affecting the consolidated taxable jurisdiction, presumably if there are both DTAs and both affected at different dates?
Yeah. Okay, so the next section deals with goodwill. Okay, I'm not going to spend too much time on this. So I'm going to spend just a couple minutes to give you like the buzzwords, but this is a hard thing to follow, and it's going to sound a little abstract. When you acquire a target and books allocates purchase price to goodwill, if there is any tax basis in the goodwill, then you will treat the goodwill as made up of two components. So this is very commonly referred to, like you see in the left-hand side of the diagram, as component 1 and component 2. Okay, so let's say we buy a target and the goodwill for book purposes is 300, right, like it was in one of our earlier examples. If there is tax basis in goodwill, which there could really only be if the target had done another acquisition before and did a basis step-up transaction. Like that's the only way that a target would end up with tax basis in goodwill. If the target had basis in goodwill of, say, 50, then that means you have book goodwill of 300, tax goodwill of 50. So you have a difference of 250. On the first 50, book equals tax. Book basis 50, tax basis is 50. That is what's called component 1. When for tax purposes you amortize that goodwill, because right, goodwill is amortizable for tax purposes, the book basis will stay 50 because it's not amortized for books, but the tax basis will go down ultimately to 0. When you deduct that 50 for tax purposes, that will create a deferred liability. Okay? So while you wouldn't create a deferred liability on the opening balance sheet when you do an acquisition, when there's book basis but not tax, you will create a deferred liability if that difference is caused by you amortizing goodwill for tax purposes. But that's only true for component 1. Component 2 is the 250 in my example. It's any book goodwill above the tax goodwill. And for that, you don't set up a DTL. You do nothing with it. So component 1, you treat like book equals tax, and any future book tax difference creates a temp. Component 2, you do nothing. That's all you got to know. Okay? But at least you can use the lingo. Component 1, component 2, everyone knows about that. Okay. So, contingent consideration. So sometimes when you buy a target, you pay a purchase price, but then there's something that can change the purchase price, right? These are commonly referred to as earnouts. So like, say I buy a company that Kate owns and I pay $1,000, and she's like, well, pay me $3,000. I'm like, no way, you totally think your company's worth more than it's worth. And then she might say, well, okay, fine, pay me $1,000, but then pay me 10% of the revenue for the next 3 years too. And that way, I'm only paying her if this thing's generating revenue, which is good for me because there's revenue, and it kind of validates her theory that the company might be worth more. Okay? So that additional purchase price that's contingent on something future, something that will happen in the future, that's contingent consideration. Okay? So the way the book accounting works for that is they will come up with an estimate of what that future consideration is worth based upon their best guess, their fair value. So if they think that earnout in my example is worth $200, then they'll treat $200 as purchase price. And for tax purposes, we're buying stock in my example, and so it doesn't affect the inside basis of the assets. So what happens then in the future is, for books, again, they started by assuming it was worth $200, but then let's say that it's looking promising that I'm going to pay her more. So the book guys need to accrue not $200, but say $300. The first $200 that they accrue goes through purchase accounting and affects goodwill. So additional $200 of purchase price might mean additional $200 of goodwill if goodwill's a residual. But like 6 months later, if the company says, oh, it looks like we're going to have to pay more under the earnout just based on how the business is doing, that extra $100 that we have to accrue as a liability, that goes through P&L. Okay? So oftentimes you see in an acquisition, in the income statement of a buyer post-acquisition, you will see the changes post-acquisition go to the income statement. And if a company accrues another $100, so they say debit P&L 100, credit liability 100, because we might owe Kate, that 100 of expense, this is going to be perm. Because we're never going to get a deduction for that expense. All that 100's doing is going to the basis of our stock and our subsidiary. We're not going to deduct that. And though we're not covering it in this class, even though you could potentially have a deferred tax asset or liability in the subsidiary shares you own, for purposes of this class, we're going to assume we don't, which is by far the most common approach. Okay. So books is recording changes in the value of the earnout through the P&L. Tax is saying, I don't know what that's about, but none of that is taxable or deductible. So in these situations where you have contingent liabilities, you very often have a perm item. Okay. So like here's an example. So buyer acquires target for 200 plus a contingent payment, and the value of that is 50. So their total purchase price on day one is 250. Fair value of the identifiable assets is 200, and the tax basis is 25. Okay, so they book their opening entry by crediting cash 200 for what we knew we had to pay, plus accruing another 50 as a liability. That's our total purchase price. We said the fair value of the assets was 200, and now the rest is up to us. We book a DTL for the basis difference in the depreciable assets, identifiable assets. So we book 70 of DTL. And then the goodwill becomes the 50 of excess purchase price before deferred taxes, plus another 70 of DTL equals 120. So that's what we would do on our opening balance sheet, and that assumes that the contingent payment has a fair value of 50. So now we're going to say, well, what happens if it's not 50? Okay. So if we pay it at 50, nothing happens. But if instead we pay 100, okay, so we pay 100 in cash, well, we reverse our liability, but now we've got a P&L entry for the additional 50, right? Like this is our change in value. Okay. So that is recorded as an expense for book purposes, but it's purchase price for tax. And so it's an unfavorable perm. Okay. So in a situation where there's an earnout, this is common. This is just like basic mechanics. But as you can imagine, sometimes this is not a small number, and so explaining that perm in your rate rec is not fun to do. Okay? It's hard to predict this. It like happens one year but not another. So it's sort of a messy addition to your provision calculation.
Can I ask a quick question?
Sure.
So if there's a deferred comp, say the shareholders get an additional 10 million or whatever if they stay for 3 years after you quit, because the employees were shareholders in the private company before.
Yeah.
For book purposes, if that payment arises in 3 years' time, for book purposes, they would report that as compensation. So you think for tax purposes it's consideration and it's calculation?
Okay, so Yusef is asking a question that is a very common question. So often, this is a very Silicon Valley deal point. So let's say that we have a target. And you could tell me if I'm hearing your question right. But let's say that I own some of the company, and Kate owns some of the company, and Michael owns some of the company. And then Yusef Co. comes along and wants to buy us. Okay? So you want to buy Target. And you want to buy Target in a taxable stock purchase. So normally that means you give cash and we give shares. Okay? But sometimes, like let's say that Michael's the key guy. Like he's the Elon Musk of this thing, right? And you're like, I gotta have that. But like Kate and I, we're just like venture funds. We're like, we don't like you, you don't like us, we just want money. You want to give us money, and so we're gone. Give us money, we'll never see you again. But like Michael, you're like, you gotta stick around. So we get our cash, and we bolt. And then Michael, you say to Michael, well, I'm only buying this company and paying him if he works here 2 years. Otherwise, he doesn't get anything. And so normally you'd say, well, that's messed up, because why wouldn't he get paid in the same way Kate and I get paid? We're all shareholders. Why would we get treated differently? And the answer is, it's too damn bad. Because the only reason Yusef's willing to buy the company is if Michael stays. So if Michael says, I'm not staying, then I don't get my money and Kate doesn't get her money either. The company's not for sale. And so in that situation, it's confusing because when you made the payment to us, to Kate and to me, it was very obviously purchase price for the shares, right? Why else would you pay me? But then the question is, when you paid Michael, what was that cash for? Was it purchase price? Or was it comp? Is this your question? Yeah. So this happens a ton. Okay. All right. So now the question is, all right, well, books. We'll do a little matching game. What does books treat this as? We have book and tax. Okay, so now we got to match these up. Does books treat this as purchase price, the payment to Michael, or do they treat it as comp expense? Don't answer, you said. Anybody else? Anyone want to guess? 50-50? Comp. Books treats it as comp because there's a service requirement. Once you have an employment requirement, books just like shuts down. They're like comp. Okay? What is tax treated as? Not always, but usually purchase price. Right? And the idea is Michael's getting paid the same that I got paid. He's getting paid for his shares. The fact that he has to keep working a while, that's great, but he's getting paid for his shares. Okay? And you can see the debate you could have on this, right? Because you're like, wow, but he's not getting paid unless he works there. And then you're like, well, all right, but he wouldn't get paid if he didn't have his shares. And so it's like some of both. And trust me that in practice, people treat tax as purchase price in the vast majority of cases. So that means that there is a book P&L charge that is not tax deductible, right? And so that'll be a permit. And so it's very common to see that happen. In fact, if you dug into some of the financial statements for some of the big companies that have done acquisitions like this, which again, they're everywhere, you will see big rate spikes because of the fact that this is showing up in the P&L, but there's not a corresponding tax deduction. And if you think of the companies that are very acquisitive, like I have one client that, they buy between probably 5 and 10 companies a year. This just adds up, right? If you do this on every deal and you start adding up, like all the Michaels and all the book expense related to the Michaels, it's a lot. In fact, there was one deal I worked on where one Michael, he was $185 million, was that number. So his book expense of $185 million, not tax deductible, just for one schmo. Yeah, pretty wild. Michael's treating his capital gain for sure, right? Unless he's a patriotic American, I'm not sure. We were talking about, yeah. No, that's purchase price. This is book expense for compensation. It seems similar, right? It's just another flavor of how you're transferring consideration to the other side, but it's very different because in the earn-out situation, books is clearly saying this is purchase price, but because it's contingent, the value changes go through P&L. It's not compensatory. That purchase price could be to all non-employees, right? It could be to Kate and me. But in this situation here on the slide, this is Michael's getting paid and is in this sort of unique arrangement because he's a key employee and we want him to keep working at the company.
Did that 185 guy bring more money or something to the state?
No, that deal bombed. Yeah. He stuck around for his 2 years. Yeah, it's a pretty successful motivational tool. Yeah. Okay. Uncertain tax position. So in in-class exercise 1, I said that the target had a $4 million exposure, and that liability was essentially assumed by the buyer, and that liability needed to be booked on the opening balance sheet. just like any other liability, right? If we assumed an accounts payable or a payroll tax liability, we just stick the liability on the balance sheet, and if that had the effect of increasing goodwill, so be it. One issue that comes up a lot is, I mean, like 100% of the time, is let's say that the target, let's say that they were private, and they didn't really care about FIN 48, and no one was really grilling them on their financial statements, and they didn't book a lot of reserves. It wasn't a big deal to them. And then buyer comes along and says, yeah, we want to buy you, and it looks like you have exposure all over the place. So we want to accrue in our balance sheet a ton of reserves. And the reason a buyer would want to do that is because when you accrue a bunch of reserves on the opening balance sheet, you're going to accrue liabilities and debit goodwill. And so this is nice, right, that you get to debit goodwill to book up tax reserves. That's a lot better than if this was tax expense, just from the optics of the financial statements. So in acquisition accounting, you often see buyers take a very conservative view of the exposures of a target, and they want to accrue those in the opening balance sheet. That gets a little tricky when the target should have been applying FIN 48 and the buyer should apply FIN 48. It's like the same facts, it's the same company, it's the same rules. So you're like, how do you get totally different answers? And so oftentimes there can be tension around this. So if target has historic positions, the accounting guidance would say, just because, you know, there's new management or a buyer involved, that doesn't mean you get to just remeasure everything to what you feel like. Like in theory, that remeasurement should be based upon new facts. But as a practical matter, you can see how a buyer would say, hey, target, it looks like your reserves are way too low. We want them to be high for reasons X, Y, Z. So we're going to book adjustments to your FIN 48 reserves between what you had and what we want. And it's going to like magically appear through a journal entry like the black entry here at the bottom of the page. But just know that there's tension on doing that. Because it looks like either the acquirer's financial statements are too conservative or the target's financial statements were wrong. And what you oftentimes see, I mean, there's only four big four firms, right? So you oftentimes see that the auditor for the buyer is the same auditor for the target, right? Like that's not uncommon with four firms. And so when the target's auditor says, hey, we only needed reserves of 100, and the buyer's like, it looks like about 800. And it's the same firm on both sides, you're like, okay, well, which firm was right? It's the same firm. And when these are two public companies, that gets sort of difficult, right? Because you're like, one of those public companies has got an issue. And that happens. That comes up from time to time. It's sort of hilarious how the firms deal with it, because the buyer's like, it's 800. Like, I'm not going to leave 100 on the balance sheet. I want a conservative balance sheet. So as a practical matter, that tension can be interesting. All right. Valuation allowances. So valuation allowances in purchase accounting can be really strange. So let's do target first. So let's say you bought a target company and it had NOLs and it was a hopeless loser, and you're a hopeless loser. Okay? You just decide like you would be better together, right? And so when you buy that company, that target, you're going to say, well, they should probably have a valuation allowance on their NOLs because they're not using them, and I'm losing money. I don't need their NOLs. So I'm not going to book a deferred asset through Goodwill. I'm just going to put up a valuation allowance on target's deferred assets. So it looks like I'm buying nothing, right? So in effect, anytime you set up a valuation allowance on target, that goes as an adjustment to Goodwill. Because what you're doing is you're saying, well, how much of target's assets are real? And whatever the real stuff is, the good stuff, I'll book through Goodwill. But anything that's offset with a valuation allowance, I'm not going to book that. It's sort of like a net nothing. So to the extent I decide my target needs a valuation allowance, that ultimately impacts how much goes to Goodwill, because it impacts how much net deferred asset I book. However, let's say let's say that the buyer is a loser. So the acquirer is a loser, but the target has DTLs. Okay? So let's say, back to my original example of I had a good idea and it was worth a lot. Books measured it at fair value, but there's no tax basis. So you the loser, you go and you say, well, I got a full valuation allowance, I got NOLs, I'm not paying tax, this is great. I buy a target that has just one DTL for the intangible that books reflected at fair value. So normally, the journal entry to book that would be debit Goodwill, credit DTL. Like, that's what we learned at the beginning of this class. But if I book that entry, now I have a net DTL. But I don't need a net DTL. Like, I got plenty of losses. No one's paying tax here. We don't need liabilities on the balance sheet. So that means I can adjust my valuation allowance. I don't need as much anymore because now I've got this DTL I can net with my DTAs. So I'm going to debit my valuation allowance. So in effect, these guys net out. But now the question is, what do I credit? So I, as the loser, buy a company, and I get to reduce my valuation allowance because I inherited DTLs. That net entry, believe it or not, is recorded in the provision. So this is provision. So that's weird, right? So like if you think about the homework, Avago, so LSI, they were the target in that transaction. But not long before Avago bought LSI, LSI bought another company. LSI had tons of NOLs and a valuation allowance. So it was the loser in my example. So they're just like, nothing's happening here. We got no deferred, no one's paying tax. It's all good. They went out and bought a company that looked like this, that had a DTL. So they booked an entry, and you can see this in their public financials. It's old now, but you can see an entry where they booked debit Goodwill, credit provision. And I want to say, in that case, it was like $50 million. It wasn't a small number. And I remember the tax team thinking, man, this is really hard to understand. We're a loser. We just bought a company in a business combination, and we get to book provision benefit. That's weird. Right? Provision benefit seems like something that you would like earn, not something that you would like fall into. But that's just the mechanics. Well, this gets booked essentially in consolidation. This would usually get booked at the parent level. Yeah, but you're being pretty prescriptive like with what legal entity things are booked at. In reality, it gets booked a lot in consolidation with these types of things. Okay, so if you're thinking of this and you're like, hey, this is really weird, is this going to be on the exam? The answer is, it is weird and it's not on the exam. Okay, but this happens. If you're, like we were giving you a hard time, right, for being in the full valuation allowance company. If you're a full valuation allowance company and you're like half asleep, and then you buy a target and you're like, how can anything matter, man? No one's going to have deferred, no one's going to pay tax, there's nothing to do here. This would catch you by surprise and you would blow it. Right? And then usually it's not a small blow. Like this is like a big blow or nothing. Skip over some of these. Okay, so let's do in-class exercise 2. Actually, I think for the sake of time, I can just blow through it with you. So in-class exercise 2 was the same as exercise 1, but assume the buyer is a hopeless loss company, and it has DTAs and an NOL for NOLs and a full valuation allowance. Now, what is the December 31 journal entry to account for the acquisition? Okay, so let's just go up to where we did this before. And we said, here was our facts. So we can do this super fast. We said that we booked a 9.2 DTA because we inherited Target. So if buyer's a hopeless loss company, then what would we end up booking? What would be our journal entry for our purchase account? Remember, we booked two things. We booked our DTA of 9.2 and our 4 of FIN 48 exposure. So if buyer was a hopeless loss company, how would that change?
And the target's still making money?
No. Target and buyer are combined. It's a U.S. company. They're joining a consolidated group, let's say.
Also, the loss on a consolidated.
On a consolidated basis, they're going to lose money. Okay, so Youssef says a VA of 5.2. Anybody else want to guess what the right answer is?
I think it's VA considered.
Okay, Youssef's hitting on a good point.
I think it's VA, right?
I don't know. It depends how you interpret the facts. What do you guys think? It depends. It depends whether this exposure of 4.0 can be offset with this NOL. So, like, let's say the 4 is for not paying state taxes, but this NOL, let's say it's federal. So now, you still need the 4. That's good. That's a real exposure. It has nothing to do with the NOL. So you'd have to book the 4, but the 9.2 you would offset with a VA. And the fact that you didn't book the 9.2 deferred, all that adjustment would go through Goodwill. So if here we need to still book the 4, our journal entry is going to be debit Goodwill 4, credit FIN 48 4. Whereas if we were booking the 5.2, our journal entry was debit DTA / FIN 48 net 5.2, credit Goodwill 5.2. So that difference between this debit to Goodwill and that credit to Goodwill, that means that the valuation allowance against this all goes to Goodwill, effectively. Okay. So far, so good? All right. Cost to an acquisition. So here, when we're talking about costs, you have to think about, well, what costs are we talking about? Are we talking about the buyer's cost or the target's cost? Because it makes a big difference. So for starters, we're going to talk about buyer's costs. So for book purposes, buyer's costs are expensed through the P&L. So if buyer pays an accountant, a lawyer, a banker, those costs get expensed through the P&L and nothing is capitalized as purchase price. For tax purposes, the treatment of the costs can vary. Sometimes they're deductible, sometimes they're not. And you got to figure out what's what. Right? Like, so in my base case where a buyer acquires the stock of target for cash, if you paid a banker, usually the majority of the fee is deductible, but not all of it. And there's a safe harbor rule that the IRS has where you can deduct a safe harbor amount and they won't beat you up over it. Or if you want to argue with them, you can try to deduct more. For lawyer costs, attorney costs, those are almost always capitalized. And for accounting costs, it depends. So it could be capitalized, it could be deducted. But the point is that the book and tax treatment is going to differ. So one interesting issue that you have is, Michael might be buying a company, like, right now, and, well, like, let's think about, like, Avago. Avago buys LSI. They were probably working on that for quite a while before that was public information, right? So they're paying accountants, they're paying lawyers, they're expensing those costs, and nobody knows, right? It's like a small group within Avago that knows that this transaction is brewing. So you're doing the provision. You don't know if those costs are going to be permanently non-deductible or not, because you may not even know that there's a deal in the works. So let's say that there's a bunch of lawyer costs that are probably going to be non-deductible. Well, if you don't know that, then when you do your provision, you're going to have missed a perm item. Okay? So the provision rules allow you to make essentially what is a policy election to say, unless there's an acquisition that closes and you know there's an acquisition, those legal costs, until that knowledge becomes, something that the company knows, those costs are deductible. Because if you had a failed acquisition, you would just deduct the costs and it would be no big deal. There's nothing to capitalize it for. So view one is, along the way, as you're incurring costs before a transaction, you just treat them as deductible because you don't know better. And then when you have a transaction, you have to step back, pool all the costs, and then say, I've been missing perm items all this time. I got to do like a catch-up. That's what like 10 out of 10 companies do. Okay? Because view two is you're supposed to anticipate a transaction. So like if you were the provision person for Avago, you'd have to say, hey, like biz dev guys, can you tell me if you're working on any super secret deals I'm probably not supposed to know about, and like tell me what costs you're incurring, because I might need to know that. And they're going to be like, silly accountant, right? Go away. So, I mean, it may not be so like cynical, but you see what I mean. Like that, getting that information to even know what the perm item could be completely problematic. And so I don't know anybody that takes this view. So with respect to transaction costs, you got to know two things. One is the book accounting differs from the tax treatment 100% of the time. And then because you don't know while you're incurring those costs that there could be permanent differences, you essentially do a true-up if there is a transaction. Okay? The good thing is you tend not to pay your banker unless there is a transaction. So you're not going to incur costs with them along the way, typically. Usually there's just one big payment that's success-based at the end. And so you don't have a true-up for them. The expense and the tax treatment all hit at the same period. But lawyers and accountants, you have this issue. Okay. Post-closing adjustments. All right. So say we do our business combination and we do our purchase price accounting like we've talked in our basic examples. And then, like one of our examples, I think in class exercise 1, we had 60 million of NOLs. So we book our purchase accounting. This was the one where we had 9.2 of DTAs. Okay? And we do our purchase accounting, we book our DTAs, and then, our compliance team is working on the tax returns, and we're doing a 382 study, and we're figuring everything out. And then let's say that we just find that the target never added back SWIANs, meals and entertainment. Okay? And we're like, man, their NOLs isn't 60. It should probably only be like 50, because if they were doing their taxes right, they wouldn't have had such a big NOL. And only from studying all the old tax returns when we're doing this tax return for like the latest year did we figure this out. Like, we didn't know they were doing that. So this is way after the quarter in which we do the acquisition. Right? Like, so you can imagine this with Avago and LSI, right? Avago buys them. LSI's got a big department. They got a big tax return. They got tons of years of history. They got lots of NOLs. It's going to take a while for somebody to figure out, like, what were all their tax positions? Like, what's behind this NOL? Like, what silly positions could have been increasing that NOL inadvertently? And, like, I'm not saying there were any in the LSI, but, like, it would just take a while to figure that out if the facts did exist that way. So let's say 6 months go by and you're like, oh my gosh, these guys were never adding back meals and entertainment, so the NOL's too big. I guess I booked too big of a deferred tax asset. Well, now I want to adjust it. So if you want to write off a deferred tax asset, normally it would be credit DTA, debit something. And normally the something would be expense, right? Because anytime you move deferreds, it's through expense. But for this acquisition accounting thing we talked about so far. So the question is, 6 months after the deal, if you realize you booked too much DTA, can you adjust it back through Goodwill? Can you say, like, oh, oops, I didn't mean to book so much DTA in the opening balance sheet. I should have booked less. Like, I want to do it like a mulligan, a do-over. Right? Can you do that? Does anyone think you can do that? Okay. Your stuff sounds like a politician answering a debate question. You're like, I'm not sure what that answer is. No, I know what you mean. Does anyone think you can do that? Can you say, oh, oops, man, I want to fix it. And I just want to fix it through Goodwill because that's what would have happened originally. No? You think we can do it? You're like, I got a VA. Woo! All right, anyone think you can do that? You can absolutely do that. Yeah. So there's an acquisition accounting window. There's a post-closing period that you can do true-ups through Goodwill. And what Youssef was saying is you can adjust Goodwill for post-closing adjustments if in your financial statements you've told people that the acquisition accounting window remains open. So when you see a company that's done an acquisition, there'll usually be a disclosure, and in that disclosure they'll say, like, we're still refining our purchase price allocation, and once we finish our tax returns for the last tax period of target, then we'll do a final adjustment or something like that. Or, once we hire pension consultants and we figure out what that pension liability really is, it's going to take us a while, but then we'll adjust what our liability assumed was. Like, it's not a tax-only thing. Okay? So you get 12 months to make adjustments. The key is that you're adjusting the facts that existed as of the balance sheet date. So if something new happens, then that doesn't necessarily go through Goodwill. Right? So like if you bought a Target and it had a building and it was worth 100 and you booked 100 on the opening balance sheet, if after the acquisition it burns down, you don't write it off through Goodwill because it burned down after you bought it. But if the building had burned down and no one told you before the acquisition, they just told you the building was worth 100 and you believed them, and then you realized later it had burned down, then you would adjust it back through Goodwill as long as you're in the acquisition accounting period. Okay? So this is sort of common sense. You get a year to refine your opening balance sheet because it's hard to get it right. But there is a lot of pressure on companies to do all their due diligence in the front end of a transaction, know all the facts, and get it right the first time. Because if you're making big adjustments like 6 months and 9 months later, it just is confusing for people. I mean, they don't like the balance sheet jumping around in a period that's not in the period with the acquisition. It just doesn't seem sensible. Okay, make sense? So, no, I don't even want to talk about that. Okay. In class exercise 3. So let's just talk through this one. Same as exercise 1, but in year X4, we bought the company in X1. The pre-acquisition target returns are audited and an assessment of $14 million is made related to the exposure known at the time of acquisition. So we knew there was an exposure at the time of acquisition and we accrued a liability, right? But the liability was how much? 4. We got assessed 10. So that means we got to credit cash we got to credit cash 14, debit our liability we already had of 4, we got to debit something else of 10. It would be great if we could debit goodwill of 10, because we'd say, hey, this is pre-acquisition, right? We inherited this thing. That was a liability we assumed. We should have adjusted goodwill for it. So can we do that? No. It's too late, right? Like our 1-year period has gone by. If we got assessed 6 months after the deal for this, and we said, oh, that $14 million, that was like really a liability when we bought the company. Like something didn't just happen to create that. It's just the $4 million was too low. Then that additional 10 we could book through goodwill in that case. The problem is 1 year is a very short period of time to resolve tax exposures. I mean, if you think of most large corporations, they're getting audited for years that are like 5 and 6 and 7 years ago. So if you think that you're going to resolve, say, like a 2013 exposure in 2015, it's not going to happen. And if you say, oh, I got a year, I'll wait, well, it's still not going to happen. I mean, these things take a long time, especially if they're a big company with big exposures. So the 1 year window, while that's nice, and it'll catch some things, it will miss a lot of things. And usually what happens is people will be incentivized to accrue large reserves and just be conservative, because any adjustment later will be good news to the P&L instead of bad news. So it'll be the opposite of these factors. But of course you can't predict you can't predict what the ultimate answer is. You just do your best. Right? If you have indemnities, you wouldn't worry about any of this. No. Indemnities are a trick. So the way an indemnity works is, let's say that you bought a company from Michael, and he said that, look, there's a $4 million exposure, and if you incur it, I'll pay you back. Like, you were willing to buy my company for $100 million, and if you have to pay the $4 million to a government, I'll give you $4 million of the 100 back. Okay? And let's say Michael further says, look, if there's any tax assessment for pre-acquisition taxes, I'll pay you back for it. I will indemnify you. Like, I want you to buy my company for what it is, not for all the prior, like, skeletons in the closet. Okay? So when you book an entry that is debit, you're going to credit FIN 48 liability for 4. You're going to debit indemnification receivable for 4. So on your opening balance sheet, there's no goodwill. You're going to show a gross liability that you might owe to a government, but then you're going to offset that with the fact that if I have that liability, Michael's going to pay me. So I'm going to book a receivable. So that would be the typical entry that you would book. So now here's why this is kooky. So let's say that the statute lapses, you don't get assessed. Okay? Michael's like, that's fantastic, I needed the extra 4. So now when you debit FIN 48, you credit tax expense for 4. But when you get rid of the indemnification receivable, you debit other income. So this is P&L, and this is P&L. So the P&L washes, but not within lines in the P&L. So this is going to be in PBT, but this will be in tax expense. So the geography of the movement of an indemnification is very confusing. So net income is a wash, but the lines within the profit and loss statement, the items move around in a confusing way. And the whole idea is that this is with a tax government. This is with a due. Right? And there's different accounting rules when you owe a tax authority versus you owe a due, right? Or a due owes you. And those rules just dictate like how the movement in those balances gets recorded. So while it may not make sense that it's perfectly a wash on every line in the financial statements, that's just what happens. Yeah. I know. It's nutty, right? I mean, that's a perm. The fact that you have other income, it's an expense that's non-deductible, but then you get this perm good guy that shows up as it's just a little nutty. Yeah. You don't see too many indemnifications, though. Or you see them like held up as escrows for 1 year or something like that, but you don't. And oftentimes when there is an indemnification, companies will try to argue that they shouldn't book the receivable because they're not really going to chase Michael down. Like he's long gone, you know, he's living in like Czech Republic by now. Yeah, that's fair. Okay, so when you do an acquisition, you have disclosure reporting requirements. And we're going to talk through those by looking at the Avago 10K. And then the last thing I'll say here is part of that disclosure requirement, and we'll see if we can see it in the Avago 10K, is if you keep your acquisition accounting window open, you need to have a little disclosure that addresses this. So if you say the initial accounting is incomplete, then you're supposed to say why and the nature and the amount of anything that's still in flux. Okay? So let's see if we can find in the Avago 10K. Okay. So here, I'm not going to the tax footnote. There should be a footnote here, yeah, that deals with acquisitions and investments. Okay? So they have a lot of deal activity. On May 6, 2014, we acquired LSI for $6.5 billion. So if this was May 6, 2014, these guys have a 1031 year end. So this is the 10K for October 31, 14. So they just did the acquisition 4 or 5 months before the end of their year. Okay? So we paid a bunch of money, and then not long after, we sold some of their business to Seagate for $450 million. We also sold some of their business to Intel for a bunch of money, and that transaction closed right after our year end. Separately, we bought this other company. That was in 14. In 13, we bought this Psyoptics company. This Psyoptics one was the one I was telling you about, where they booked a valuation allowance benefit through the P&L. That was Psyoptics. They made other deals that were small. In 12, they made 2 acquisitions. So these guys got a lot going on, right? Okay, for each acquisition, the allocation of purchase price goes to tangible and intangibles based on its fair value, blah, blah, blah. So this is some generic language. All right, so here's like the LSI acquisition. So on May 14, we bought LSI. We paid a bunch of money. We paid their shareholders. We cashed out the options. We assumed some stuff. We paid $6.5 billion, but they had a bunch of cash, so really we paid a net $5.5 billion. Okay, so that $5.5 billion. Okay, I'm going to come back to this. We allocated the purchase price to tangible and intangible assets acquired and liabilities assumed based upon their estimated fair values. So they took the 5.6 and they pushed it out to the assets. The fair value was determined based on estimates and assumptions made by management at the time of the acquisition. So that was during their third quarter, because if they're in October year-end, that means July is a quarter year-end. July quarter year-end would have included May. So in Q3, they bought the company, but then they say, during the fourth quarter, we made adjustments to certain tax balances during the measurement period, which is that period that's open, resulting in a $62 million increase in goodwill. So that is code for the tax guys found some crap, right? They found liabilities, and so they said, hey, we got to book those liabilities by crediting liability, and we want to debit goodwill. That's what that sentence means for $62 million. And then they say, as additional information becomes available, we may further revise our purchase price allocation during the remainder of the measurement period, which won't exceed 12 months. So that's them saying, we found some stuff one quarter after the deal, but we're looking still. So this is them telling you our measurement period is still open, at least as of the end of this 10K. Like it's closed by now, because they just had a year-end for October 31/15. But as of the date of this 10K, this was them saying, we can keep booking things to goodwill as we find them. Okay? So then here's a table that says, here's our allocation of purchase price. Okay, do you see the tax stuff? Where's the tax stuff? It's buried. Right? You can't find it. There's no respect for tax people. Can't even get your own line in the purchase price allocation. It's in there, you just can't see it. Yeah. I mean, I don't want to tell you stuff that's non-public, but yeah, trust me. If there was a big net asset or a big net deferred tax liability to book, you would see it. If they're small numbers, they'll get combined with the other numbers, right? I mean, that's just in general what you can take away from any public financial statement. One other required disclosure is when you buy a business. Here, remember, there is goodwill. There's $1.2 billion of goodwill. There's always a requirement to say whether the goodwill is tax deductible or not, and so in this sentence, goodwill is not tax deductible for tax purposes. Okay, so they have a bunch of other disclosures. Like this disclosure will show, like, it's funny, sometimes a lot of work goes into this, but I don't think anyone ever reads it. This disclosure says, hey, if we had always owned this company, like this would have been our Avago revenue combined with LSI. This would have been our profit with Avago and LSI combined. This would have been our EPS. Just to give somebody an idea of, like, if we had always owned them, we would have looked like this. But those numbers get put together in a very imprecise way. In fact, I'm working with a company right now to do the opposite. They're selling a company, and we're showing what the pro forma would look like if we never had them. Okay, so then they move on to another deal. So they say, we acquired this company. This was the purchase price. This is the allocation, blah, blah, blah. So here's another one, the Psyoptics one. Let's see if I can find any stuff in here that's interesting on tax. So like this one in the purchase price allocation, you can finally see that they have deferred tax liabilities right here. So they say we paid $377 million. Hold on a second. Nope, TLX. Psyoptics. Yes, we paid $377 million. So then we go down, we do our purchase price allocation. It's all going to net to $377. We got assets of 463. We assume liabilities of 86, but in those liabilities assumed was 54 million of deferred liabilities. That 54 million looks a lot like 35% of that 141. So that would be super common, right? Books allocates value to intangibles. Tax doesn't have basis. Take that times the U.S. rate. That gets you a DTL. That DTL makes the goodwill go bigger. Like, that's really common. That one, like, looks uncanny that that's 35% of that. So here's one thing that addresses actually your question, Youssef. There were no significant contingencies assumed as part of this acquisition. As of November 2014, we had 6 million indemnification receivable and other long-term assets for tax positions related to Synoptic's value-added tax and income taxes payable existing prior to the acquisition. So remember that thing we were talking about? They had it. So they actually told you a little bit about it. They don't go on to explain that there's going to be some weirdness in the P&L when this balance moves, but that saying that statement might be their way of saying, hey, we told you there's some gross balances out there that you might need to keep track of. Like, no one that walks the earth would be able to figure that out unless you knew these rules. But that was that's probably why they said that. All right, that's it. So
when would Goodwill be deductible?
When would Goodwill be deductible? Goodwill would be deductible if you did an asset purchase. Or 338. Or if you bought stock of a target and they had bought a company before you bought them in an asset purchase. And so you're inheriting their tax basis. Like, that's very common. Okay. So that is business combinations in 2 hours and 40 minutes. All right, questions on that? Is it going to be on the test? Yes. All right, any other questions? This is a super interesting topic. Like, if you're a provision person and you get to work on business combination accounting, like, this is interesting. It's always sad when I have to tell you this is interesting, but this is interesting. Okay? It's like I tell my kids, now is when you're having fun. Okay, so next week we're going to talk about quarterly provisions. Your homework is to review the Yahoo 10Q. You'll see that their quarterly rate is all over the place. It is all over the place. Like, it will crack you up. So I want you to try to figure out, like, why is the rate just like going like a balloon you let the air out of? Like, that is really what's happening. See what you can figure out from their public disclosure. I think in Q2 it was like a negative 100%, something like that. It was just bizarre. Okay, so then what I want you to do is find 3 public companies. This is what you have to turn in. Find 3 public companies, take their Q1, Q2, and Q3 ETRs, and explain why they differ. And don't pick companies where they don't differ. I'm not a dummy. Okay? Don't pick like Apple or something. It's just like, right? Pick companies where they move around. It's not going to be hard to find. But see if you can figure out why they move around. It's not easy. So like, I'll give you an example, like Intuit. So that was one of our homework assignments earlier in the course. If you want to look at one where it moves around, pick up theirs. It always moves around. It moves around for the same reason every year. The quarter over quarter, it's volatile. Even though at the year end, it's very steady year after year. And there's a very clear reason why that's the case. But I think you'll find it very hard to understand that. I can't recall what's in the public disclosures. I think there's like a little nugget. And I'll explain it, but see if you can figure it out for yourself. Like, is it something about their business, or is it some like event that happens every year, or is it something like with their tax audits? Like, what is it? But it's some like recurring theme that every year that makes if their annual rate is say 35%, which is roughly what it is, their quarterly rate is not 35 every quarter, but it always ends up at 35. So the question is why? Why does it bounce around? And then if you look at Yahoo's, you'll find it's like all over the place. There's like no rhyme or reason. And if you look at this year's Q1, Q2, Q3, it'll look very different than last year's Q1, Q2, Q3. But if you pulled up those 6 financial statements and you tried to understand why, I'll bet you'd be able to figure it out. Or at least the macro concepts. Obviously, you're not going to be able to figure out the details. Okay? But I want you to find 3 companies, schedule out Q1, Q3, and then turn in something that explains it in words. Okay? So I looked at this company. Their Q1 rate was this, their Q2 was this, their Q3 is that. The reason they're different is beats the crap out of me. Right? Or something more intelligent would be great too. Okay? There's plenty out there. If you can't find one company where you can come up with something educated and say, oh, they disclosed that they had this thing, and that's why their rate popped up in this one quarter but didn't in another quarter, you will be able to find those. Okay? So don't pick 3 and say you can't figure out any of the 3 and turn that in. Okay, it's going to say that didn't count. Come up with something decent. Okay? All right, and even though on this slide it says turn in your final by November 23, turn it in by November 24.